I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Brett Swarts. Brett is the founder of Capital Gains Tax Solutions. He's a licensed California real estate broker who holds Series 22 and 63 licenses, and he's the host of 2 different podcasts. Brett, I'm gonna stop there on the introduction. Thank you for coming on the show, but I'm really excited to hear, sort of from your mouth what it is you do. So again, thank you so much for taking the time out.
Jason, my pleasure to be here. Thanks so much for having me on the show. So, most high net worth individuals, they struggle with capital gains tax when they go to exit their highly appreciated assets. And this includes real estate, business, cryptocurrency, primary homes, artwork, collectibles, NFTs, you name it. And so we use something called a deferred sales trust to give them capital gains tax deferral, liquidity, diversification, and the ability to have freedom with their capital. And I mean freedom by, investing into real estate at their own timing, into the stock market, into cryptocurrency. Also, they can create and preserve more wealth. And so we're in the business of tax, of wealth, of ways to create freedom, Jason.
Cool. Well, let's back up a little bit and just tell me a little bit about your background and how did you get into sort of this area? Because it's obviously not very common. So what got you started to that?
Yeah, great question. So I actually started out in my life, if you will, from a very young age, working with my mom and dad in the real estate development Bay Area of California world, where I grew up in rentals, cash flow, being an entrepreneur, like watching my dad be an entrepreneur, wanting to be an entrepreneur. And so that kind of helped me to fall in love with real estate and business. But we're in Taxifornia, right, where I am, but it's very, heavily taxed. And so we've seen that increase over the years, and went on to not knowing that would be in this part of the tax world, but basically went on to college, studied business, played some hoops in college, and then took an internship at a place called Marcus & Millichap. And this is where we studied how to help people and practice how to help people sell multifamily investment properties, do 1031 exchanges, cash flow, IRRs, cap rates, all of these type of cool things. Fell in love with that, but it wasn't always easy, Jason, because that was 2006. Things were going really good. And then something happened in 2008. And that was the crash. And where I went from making a little bit to almost nothing overnight. And that was a real wake-up call, because I don't know if you've ever been so scared, not sure how you can provide for your family and where the next meal, where you're going to be able to provide for rent. Well, that's where my wife and I found ourselves, and with a baby girl on the way. And so I did what every good entrepreneur or real estate wannabe does. You go get a side hustle. And so my side hustle was a place called Cheesecake Factory. And so nights and weekends I would work there, serve cheesecake and be a server. And then by day I'd make cold calls and negotiate with banks on behalf of my clients to try to keep their properties, to try to help them figure out a way to increase the rents, decrease expenses, and kind of just serve them in that area to hold on to these properties. So I was going through my financial struggle, and so were they. And this created, kind of like the perfect storm for the deferred sales trust, because we looked back and said, there's got to be a better way. This 1031 exchange does not always work. And in fact, in this scenario, it was our enemy, because people had overpaid. They had sold high and bought higher 180 days later with too much debt, not enough liquidity, not enough diversification. And now they were losing or trying to hold on to their properties, and half of their wealth is gone. And so at the time, my manager brought in a gentleman to speak on the deferred sales trust, and he became my business partner. And he basically taught us that there's a Netflix way of doing things. Now, he didn't use the word Netflix. He just said there's a tax deferral strategy that doesn't involve a 1031 exchange that could have saved and helped all of your clients. And we thought it was too good to be true. We're like, no, we got this blockbuster thing, and it's really cool. It's a 1031. We don't need you. No, you don't understand that. That's the root of the problem if you don't use it properly. And this new version is a better way to do it. but it goes back thousands of closes, billions under management over 26 years now in existence, over a dozen no change IRS audits. And so we said, well, if it is true, it'll change everything. And so that began the journey of rolling it out to my clients, trying it, testing it, speaking with the tax attorneys who created it, building the confidence and the education on what it is and what it's not. Fast forward, I became a trustee because I had all of a sudden a lot of knowledge, because at one point I had no knowledge of this. Now I do. And they said, why don't you be a trustee? Why don't you coach and train people how to do this? And so I was able to retire from the Cheesecake Factory. My wife was able to stay home with our 5 kids. And now this is all I do. I just train and coach people how to do this and help people exit really, really smart.
Okay, cool. So you're maybe let's start by just defining a 1031 exchange, because I know we're referring to that as the blockbuster way. I think it's also probably what's front of mind for most people when they're selling and they're trying to decide how to sort of defer some of that tax hit. That most people think of 1031 exchange as their sort of first option, but maybe let's define that for the listener, and then you can explain how the deferred sales trust is different and and better.
Sure. The 1031 exchange is a part of IRC section 1031 in the tax code, which allows individual property owners that have investment property sell and move it or exchange it or trade it and buy another property and maintain tax deferral on all of the gains. So let's say you bought a property for $1 million, Jason, and it's worth $3 million. Well, if you were to sell in California, it's about 37 to 40% in tax. You'd pay about $800,000 on that $2 million gain. Well, instead of paying all of that, guess what you can do? You could roll all of the $3 million into another property, okay? As long as it's equal or greater value. So if you sold it $3 million, you got to buy it $3 million or greater, and equal or greater debt. And that allows you to take what you would have paid, the $800,000 in this scenario, and keep it working for you, right? Which is really cool, right? Because you can build more wealth. You can take that $3 million and build it maybe to another $3 million over a 10-year period of time or a 5-year period of time. And it's a great way to just compound your earnings and your gain to build wealth, okay? And so, again, 1031s are fantastic if you can find a deal that makes sense. And what's that? Well, it's different for different people, but typically it has a good solid cash flow and has a good opportunity to raise rents or to add some value, something where you can do some what's called forced appreciation. And that can help you build the wealth in that property. But what we're seeing right now is this marketplace where things are all-time highs, and it's harder and harder to find value-add properties, and especially because you have to identify it within 45 days. And this is why we call it like Blockbuster, because I don't know if you remember, Jason, going to Blockbuster on a Friday night, you see that movie behind that cardboard, and you're like, oh, that's the movie I want. And you're walking over to get the movie, you're all excited, but somebody's 2 steps ahead of you, and they look at you and they grab the exact same movie, and the cardboard goes flat, and you're like, oh, I wish movies were just available, right? Why do I have to not have the movie that I want? And even if you got that movie, though, you have to take it home and return it within 3 days. If you didn't rewind it, before they had DVRs or DVDs, that you get a fine and a penalty and all this stuff. Well, Netflix came out and said you don't need that. You'll never have to return it. There's no return fees. There's some ongoing fees, right? But the movies are never checked out. You can do it from the privacy of your home. All this cool stuff. Well, that's like the deferred sales trust, because the main thing with the deferred sales trust is there's no timing restrictions. So the best deal stories for this is for a gentleman. This is actually why I started the company, because in 2006, he was selling a property in Minnesota, and this property was for $20 million. And this guy loves investment real estate, done 1031 exchanges and built a ton of wealth over a couple $100 million. But for the first time, he's looking around with his 1031 binoculars, and it doesn't look good. The storm looks like it's coming, and he's like, I'm not going to 1031 and overpay because these prices are too high, but I'm going to try this deferred sales trust thing because I don't want to pay all this tax. And so he put the money into the deferred sales trust, and he became the lender, which is this, how we do this. And 5 years later, the bank calls him up and says, hey, you know that property you sold? And he goes, yeah. Well, we just foreclosed on it. By any chance, would you want to buy it back? And he goes, well, maybe. What's the price? And they say, well, it's 60 cents on the dollar. He goes, that sounds like a pretty good deal. Give me a couple days. Well, in the meantime, his funds were sitting tax deferred in stocks, bonds, and mutual funds, diversified, liquid, investment grade securities, hedged and protected, not something that's subject to the huge crash as well. There's ways to do that. Okay. We work with third-party financial advisors to put these things together. Well, had an LLC, partnered with the trust, and he bought back his property at 60 cents on the dollar. And this is when my brain exploded because I'm going, no, everyone told us we have to do it within 45, 180. That doesn't make sense. But I'm like, no, you can. You can sell high and buy low. And so that's really the biggest difference. We can go on to some other ones as well, Jason, but I'm going to take a pause there because I said a whole lot.
No, that's a great explanation. And I think that the main issue with the 1031 exchange that people run into is exactly what you mentioned, is the timing. And so you have to make that new deal, you have to identify and then actually close on that new deal in very specific time periods. And the problem is that if there's not always a good deal available in that time frame, people can go 6 months, 9 months before they come upon a really great deal, especially now in these inflated prices, compressed cap rates type market. And so the deferred sales trust then, I guess, allows you to avoid all of that. And so logistically, what happens? So maybe walk us through a deal like that. If someone is going to use a deferred sales trust, what are they doing? They sell their property. How does it all work? How do they get, that money back? Kind of what happens in the meantime?
Absolutely. And before I go there too, I want to remind everyone too that the 1031 exchange only works for investment property, whereas the deferred sales trust, can it work for Bitcoin? Yes. Can it work for artwork? Yes. Can it work for investment property? Yes. Can it save a failed 1031 exchange? The answer is yes. Can it work for a primary home? Yes. So it works for everything, right? So that's also why it's like Netflix, in that you have all the variety of everything all at once. Whereas the 1031 is like Blockbuster because you only have that one investment in real estate. So that's really important. We just did a $5 million exit for a Bitcoin client of ours. She worked for Google, and she no longer works for Google because her Bitcoin went from about 50,000 to 50 million. But she had a big challenge. She didn't want to exit and pay all the tax. And so instead of paying all the tax, she was able to put it into the deferred sales trust, defer the tax, and then partner with the trust to start a business venture, which is a really cool thing you can do. Very flexible. And earn on the trust and live off the income of the trust and just slowly pay tax. And so how does this all work? Well, step number one, you form a deferred sales trust. Now, with our firm and our company, it's no cost, no obligation. We form the trust, we consult, we walk you through the pros and cons of using this versus some other opportunity zones or 1031 exchanges, and we just get it in place. We do that for two reasons. One, we want to make sure that we're early and you haven't gone through, or the buyer hasn't gone too far in the transaction where you're not going to be eligible to use the trust anymore. Step number two is we simply insert the trust into the purchase and sale agreement if it's a property sale, or if you're working with a qualified intermediary, we work with them to put the trust in place. Step number three would be open up the bank account in the name of the trust. Step number four is you would send the funds, have the funds sent to the trust, and then you get a promissory note. And so those are kind of the steps there. And then post-close is just all about investments. So you take a risk tolerance questionnaire, and then your risk is assessed, and potential investments are presented, and then you approve or disapprove of the investments. And we all work together to accomplish paying you back your money plus a rate of return, and then you'll just slowly pay tax over time. Does that make sense, Jason?
Yeah, it does. So are you able to get any of that cash kind of out of the deferred sales trust? Is there something, if you're invested, your money is invested in syndication, there's typically some sort of monthly or quarterly distribution. Is there anything that can come out of this? Because, and correct me if I'm wrong, my understanding is that deferred sales trust has an indefinite timetable, so it can kind of just sit there as long as you want. But in the meantime, can you get any of that money? How does that work?
Yeah, how does the deferred sales trust structured, and how are the payments made? So the deferred sales trust is typically structured in these 10-year increments. And every 10 years, you can renew for 10 years, renew for 10 years, renew for 10 years. You can pass it on to your kids. And they're typically structured with an 8%, sometimes 7, 6, or 5, but typically 8% net of recurring fees paid back to you on a compounding rate of return. Okay, so let's say $1 million went in, 8% is about $80,000 per year. Okay, and most of our clients are structuring it with monthly payments coming out of some amount of that 8%. Half of that 8%, or maybe a little bit more, or maybe greater than 8%. It's your money. So the answer is yes. The money is paid back to you. That's the intent of the trust, is to pay you back money slowly over time, and you'll slowly pay tax on it. And it's adjustable along the way too. You can adjust it. Now, do we recommend you adjust it all the time? No, but you might adjust it once a year or so. You can take an initial big distribution out up front as well, and then the rest of it can continue to go. And so that's how you can structure the deferred sales trust.
So you just pay tax on whatever you take out of the trust? Is that kind of how that works? Okay.
Correct. Exactly right. So you don't pay any tax until you receive payments from the trust.
Okay, great. What about when you identify something that you want to buy? Now, you said you can kind of put the money from any sort of sale like crypto or NFTs, which probably wouldn't have even been talking about those things 10 years ago. But ultimately, any type, can you also then purchase any asset class from that trust on the other end?
Yes, you can. So you can exit, and the trust, once the funds are in the trust, can put into a variety of investments, which is probably its best strength in that you can diversify, right? And you can go into liquid investments. You can go into real estate investments, go into cryptocurrency, and you can you don't have to be in just one single asset class, right? At one particular time, you can dollar cost average, right, in or out of these investments. And that's the idea. Like, you hit it big in cryptocurrency at $50 million. I mean, I had another client, he bought Ethereum, he and his wife, out of California and Silicon Valley for about 100,000. And they went to 13.5 million over like a 6-7 year period. But during that time period, it was highs and crashes, right? And so, had you Monday morning quarterback, every time it goes high, you exit out of it. And then you can partner with the trust to buy back in at a low, and then you can exit when that goes high again, and then just keep riding that. Like, you don't have to just ride these crazy waves. Like, you have the ability to escape feeling trapped by capital gains tax when you use the deferred sales trust. And that's one of our favorite parts about doing this, is that freedom and that flexibility. Because as investors, we know when it's a seller's market, right? Especially for real estate, especially for crypto, right? We know these ups and downs are coming. And especially if we can just exit at a good spot. So that's what my client did. He basically exited 5 million of Ethereum within 1 hour after about 90 days of due diligence, right? Then he exited another $2.5 million about a month and a half after that. So he's exited about 7.5 million of his 13 million, which is pretty sweet. And he put it into a diversified investment grade securities portfolio that he felt comfortable with. And he never has to work again. He never has to work for the tech company again. He's retired. He doesn't have to ride these big old waves. Like, there's a saying out there, Jason, you don't have to be a millionaire once, right? But if you lose it, you have to start all over again. And he's like, man, we've got it. We're good. Let's just keep it in the biggest companies in the world, very safe, very protected, diversified.
Okay. No, that's great. So why doesn't everyone just do this instead of a 1031 exchange? Because as I mentioned, I at least what I hear about, most often people talk about a 1031 exchange.
Yeah. So I'm a real estate broker still, right? And I'm selling 3 deals right now, and we'll be looking at 1031 exchanges as an option. So the key is if you find the property, right? So the answer is, if you can find that property that makes sense in that time period, then boom, we get a high five. 1031 exchange is super cheap. There's no ongoing fees. There's no third-party trustee, who has to be a part of the deal. Like, you just sell and you just own it, right? And that's like pretty simple, pretty easy. There's 5,000 exchange companies all banging the drum of the 1031. Commercial real estate's like a religion, and I'm a part of that religion. I love it, right? And they only teach us the 1031 is the only doctrine, right? It's the only thing you do. And you're like, well, actually, there's the thing called an installment sale. It's known as a seller carryback. And if you partner with the trust, you get all the flexibilities and none of really the downsides of the old installment sale. And so the answer is in the asset itself. So if the asset makes sense, I'll be the first one to say, hey, do that 1031. In fact, we cheer you on. We'll give you a high five. You don't owe us anything if you get it. Now, you want to work with a qualified intermediary. We have a strategic alliance that allows both of them, because guess what? Not every qualified intermediary wants you to know about this, and they'll tell you, oh, it doesn't work, or it's not legal, or we don't think it's going to work. And guess why they're telling you that? Because they want to keep you in the 1031 business. But this has worked thousands of times, been tested by the IRS, billions under management. Literally has a perfect track record. And most of the deals are done in California. One of the biggest ones is done in San Diego. And so that'd be the first thing. And I was also a 1031 Marcus and Millichap broker. And it's just really funny about that you asked this question, Jason, is that Interesting part is my first manager at the office in 2009 brought in the gentleman, and he was like a proponent of looking for creative ideas. Well, he was let go a couple of years later. I mean, the market was tough, and they fired him. And then a new manager came in, and guess what? The first thing he told me to do, he calls me in his office one day. It's like a random Friday. He's like, "Hey, I got to talk to you." I'm like, "Oh, what's going on?" He's like, "We don't want you talking about the deferred sales trust anymore." I'm like, "Well, what do you mean?" I'm like, "If it can change someone's life and save their tax, like, isn't it for them to decide? Don't we want to present the options?" No. We're in the 1031 business. We're not in the deferred sales trust business. And part of it was because the equity wasn't necessarily going into another real estate deal where, guess what? They get a commission. So you got to follow the money. So most commercial real estate brokers either don't want to know about this, or they don't know about it, right? Because they're in the business of keeping you in the 1031. I know because I was a broker, and that was the mentality. That's literally what happened. And that drove a wedge between me and them, because I said, I'm going to look out for my client and give them the option. Let them decide. And I'll go somewhere else and help them do this, right? And so that was what happened.
Great. When you are selling so if you're in a syndication and the syndication is selling, I know that you can have the option to essentially take a group of the passive investors and form an entity, and they can 1031 exchange into another syndication. Is there a way to structure a DST the same way? Can that work similarly?
Good question. So first of all, the deferred sales trust is not a Delaware statutory trust. Okay, this often gets very confusing,
right.
And this is a good time to bring it up. So a Delaware 1031 or Delaware statutory trust is like Hollywood Video. Do you have the Hollywood Videos down the street from your old Blockbusters, right? It's just a part of the 1031 family. And basically it's like a syndication that's super organized, and they allow people to take small interest into these properties, either one or two or three typically of our portfolio. And by the way, we still do some Delaware statutory trust. In fact, we just did one last week with the client because they had what's called a mortgage over basis issue, which kind of answers your other part of your question, Jason. And that, when would you do a 1031 Delaware? Well, when you have a debt over basis issue that the deferred sales trust cannot solve, and that's when we come in and we do a partial Delaware. In fact, we just did it. Ron Anderson, he's our client. He just closed a $4.2 million multifamily property in Colorado. You can watch his entire episode we break this entire thing down. He did a partial Delaware on my YouTube channel. We did a partial Delaware for a part of it, and then the rest of it went to the deferred sales trust. So each tool has its pros and its cons, right? And the deferred sales trust is used for the majority of our deals, but the Delawares are for a part of them. Now, to answer your question on the syndication side of things, it all depends, right? We just did a deal for a $20 million client out of Vegas. There are two GPs, multifamily syndication, a bunch of LPs, and they each form their own trust because they were just going to all pay the tax anyways, and they put theirs into it. Now, the LPs could have, if their deals were big enough, which our minimum is $1 million net proceeds, $1 million gain, by the way. So it doesn't work for everybody. It's got to be big enough. The pain's got to be big enough to hire us to help to run this thing, right? Now, they sold another $16 million multifamily property in Phoenix. They did it again. They rolled it into the same trust. The other LPs paid their tax. They're doing it again with another property. In fact, they're going to be doing, I think, a total of 6 properties within the next 60 days. They've already done 2. They're doing 4 more. We're closing one on Monday. And so the answer is it all depends, Jason, right?
Yeah.
But most of the syndicators that we work with, they're not doing 1031 exchanges, and they're not accepting 1031 money unless all of the stars line up and all the investors want to do it. Right. And that's where we come in, because the whole entity doesn't have to move. We can separate the partnership. Okay. Whereas 1031 Blockbuster, the whole entity must move. In our scenario, you don't have to do that. Does that answer the question, Jason, or create some more questions?
Yeah, no, it makes sense. I think that, your answer that it depends on the deal. Obviously, I think that's kind of the key with any of these structures is getting with someone who understands these different products and using whichever one is appropriate for your particular deal and your particular tax situation. It makes total sense. One of the things you mentioned was that you can save a failed 1031 exchange with the deferred sales trust. So maybe explain how that would work.
Yeah. Can the deferred sales trust save a failed 1031 exchange? The answer is yes. How does this work? The answer is, first of all, you work with Capital Gains Tax Solutions, our company, and a qualified intermediary that will give you both options. And do not ever go with a qualified intermediary that A, hasn't done this, or B, will not give you the option. I literally have had, I think, 4 calls in the past 3 weeks with millions of dollars on the line that these accommodators will not accommodate. They just say no. And you ask them why, and they just say no. And you're like, why? Well, we don't think it's legal, or whatever. Well, what does it matter? We're the taxpayer. Allow us to do these things that have been proven for 25 years, right? And it's never failed, not even once, but they say no. So that's number one. Make sure you're working with us and a qualified intermediary that will allow both an option for a 1031 or deferred sales trust. Step number two is we insert language, we form a trust, and we set this up. And on day 46 or day 181, depending on what you've identified, we can default into the deferred sales trust. It's really that simple. Instead of the funds going to, let's say, Jason or you directly, Jason, if you're the owner of the property that just sold, and receiving constructive receipt, we form the trust and the funds go there and you get a promissory note, right? That's what you become an owner of. You became a lender. This is how this works. So Jason, that's how a deferred sales trust will help a 1031 exchange.
So you would actually have to have kind of set that up in advance. Just essentially, if your plan was to 1031 exchange, but you created the deferred sales trust in case that didn't happen, it's not a situation where you could have done a 1031 exchange and then, oh, that didn't work out, and then they call you up and say, hey, now I need a deferred sales trust. You can't step in at that point and sort of save that.
What is the timing of the deferred sales trust? The answer is there's two places. Number one, at close of escrow prior to the buyer removing all contingencies, okay? And this applies to basically anything that's not an investment real estate property that's eligible for a 1031 exchange. So we got to set it up for cryptocurrency, for primary homes, for business sales. We got to set it up during escrow or prior to escrow, but definitely prior to the buyer removing all contingencies. Number two, what's the second window you can do it? Well, if it's an investment real estate property and the funds are at a qualified intermediary, we can work with the qualified intermediary, if they're accommodating, to set up the deferred sales trust while it's there, okay? And it could be on day 30, day 47, day 160, day 165. As long as the funds are still at the qualified intermediary, we can set up the trust and we can default into the deferred sales trust. So those are the kind of the windows for the timing of the deferred sales trust.
Okay, great. That's really great. Well, Brett, let's switch gears a little bit. We'll move to the part of the show where I sort of ask you the questions that I like to ask each guest, with the first one being related to the name of the show, as Know Your Why. So Brett, what's your why? What drives you? What kind of makes this all so important to you?
Yeah, I mean, there's a couple whys. I think the first one is I believe we've all been created to use the gifts we've been given to maximize the potential of those gifts and to help as many people as we can with those gifts. And then the bigger purpose that we have a calling and a mission to do that. And for me, it's I believe that's been given to us by God to do those things, right? And so I love to use the gifts I've been given. I love to maximize the potential of those gifts, make an impact as many people as I can, and that equals success and fulfillment in the career and the vocation, if you will. So that's kind of that part of the things. The other one would be, the biggest one would be my family and my daughters, my kids. I have 4 daughters and my son and my wife, and we want freedom and we want flexibility and we want to be able to travel. We want to be able to meet new people, and we want to have friends in every single part of the world, especially all of the United States. The cool thing about the deferred sales trust is I get to meet people from all different walks of life, cryptocurrency, farmers, dentists, multifamily owners, marketing business owners, NFT artists, like all of this really cool amount of diversity that I get to meet and serve these different families, different individuals, is a big part of why I love what I do. And the other one comes from the painful part of growing up with 2 parents that were amazing, but they got divorced when we were young. And I saw a lot of wealth at first and then like no wealth with my mom. And so my dad spoiled us when we were with him, but didn't pay child support as much or really much at all to my mom. And so I grew up with this like sense of like, I don't want to have any stress when it comes to finances for my family. And I want to be able to have some freedom there. And so that kind of internally helped me to drive me to be successful and to earn a lot and to grow a lot, because I didn't want that ever to come between like family. So yeah, those are some of the whys, Jason.
Sure. Yeah. I mean, they're all very powerful, but I think the reality of the impact that finances have on divorce is a big deal. It's something that we see. I read some statistic the other day that's like 60% of divorces, or maybe it was greater than that, are related to financial trouble or financial misunderstanding, even between spouses. So totally makes sense. Next question. What is something about yourself that maybe isn't common knowledge, special skill, a hobby, anything that would let the listeners get to know you a little better?
Yeah, so I played college basketball on scholarship, and so it's my passion. If I could play every single day the rest of my life, I would. My knees would hold up, and so I absolutely love, like, March Madness just ended, and I'm just like, it's like my favorite time of the year.
Yeah.
So that would be the special skill. At one point I could dunk. I'm a 6-foot white guy who could dunk, now not in a game, but like I had to be warmed up and like everything going well, but I could dunk. And then I blew both ACLs out. And then, I got a medical red shirt one year and came back, kept the scholarship. And then I knew I was back when I could dunk again. So that was a kind of a cool moment, but that would be the kind of the underground thing that people don't really know about.
Nice. Where'd you play?
So I played at first at Point Loma Nazarene University down in San Diego. It's like, it was an NEI school at the time. I think it's like Division II now. I was a walk-on though, so didn't get a lot of playing time. And then I played at Mesa Junior College, and then I got a scholarship to a place called William Jessup University up in Sacramento area.
Awesome. Who are you? I guess when this comes out, people will be well beyond the championship game, but it was last night. Who are you rooting for?
Last night I was actually rooting for Kansas because I'm a big Duke fan, and Duke lost to North Carolina. However, I'm a huge Michael Jordan fan, so part of me was like, it would be cool for Michael's team to win. But yeah, so I was Kansas last night.
There you go. I like when we get a little tangent on sports. I'm a big sports fan, so very cool. Where can people reach you if they want to reach out after they hear this and they're interested in deferred sales trust, or just getting to talk about this stuff with you?
Yeah, the best place to find me is to go to YouTube or my website by searching Capital Gains Tax Solutions. Our website is capitalgainstaxsolutions.com. We also have on iTunes, we have the podcast, Capital Gains Tax Solutions. Of course, Instagram, LinkedIn, Facebook, all of those pages as well for all the socials. We are coming out with our book, and it's called Building a Tax Deferred Exit Strategy. What's cool about the book, look for that on Amazon. Some really smart people in it. Like a guy like Kevin Harrington from Shark Tank will be in the book, which is amazing. And I tell my whole story, and we give you a bunch of strategy on how to grow wealth and how to use tax deferred strategies to do it.
Very cool. We'll put all that in the show notes too, so people have it and they can find you easily. Final question, Brett. What piece of advice would you give to people who are getting started, whether that's in business or real estate, and they are, sort of looking to achieve the level of success that you have? What would you tell them to inspire them?
Yeah, learn to work harder on yourself than you do on your job. If you work hard on yourself, you'll make a living. But if you work harder on yourself, you'll make a fortune. And the idea is not to make a bunch of money, although that's really cool because you can help a lot of people. The idea is to become everything you were created to be, to maximize and identify those gifts, those strengths, or to maximize the potential of those gifts and strengths and impact as many people as you can, and to fulfill the mission you have for your life. And so, whether that means you're in college, whether that means you're in your career, whether it means you're even a successful entrepreneur, we got to always go back to the fundamentals of what are the strengths and the gifts I've been given. How do I maximize those things? And then how do I work harder on myself, my health, my finances, my faith, my fitness, the financial intelligence, right? All of these things are big. And instead of focusing on like the outcome, focus on the internal things and the knowledge that you can grow, and fortifying and building your character. Then the rest of the stuff takes care of itself. That's what I would say.
I love it. That's a great piece of advice. Thank you so much. I appreciate all that you shared with us. I think this is a really useful strategy for people. And if they're interested in, they got a sale coming up, they for sure should hook up with you and get connected on this. Makes a lot of sense. So thank you again for your time.
Thanks, Jason.
All right, we'll sign off. Have a great day, everyone.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.